Okay, so imagine this. You wake up, you roll over, grab your phone with one eye open, and you see a push notification that makes your heart just stop.
The good kind of stop or the bad kind of stop?
The kind that says you've just been credited with $133 million? dollars?
Uh, that's the kind of notification that either give you a heart attack or, makes you book a private jet immediately.
Right. Well, this actually happened February 6th in South Korea, the Bitham Exchange.
Oh, the fat finger incident,
That's the one. They were running a standard loyalty promo, meant to give users a tiny reward, 2,000 South Korean won.
which is, what, $1.50?
About $1.50, basically nothing. But someone in the back office made a huge mistake. Instead of 2001, they credited users with 2,000 Bitcoin.
2,000 Bitcoin.
Yeah.
Per person. I mean, that's just an astronomical amount of money.
It's nation-state level wealth. And here's where the story gets really telling about the state of crypto right now. People didn't call customer support. They didn't ask if it was real. They just panicked.
They tried to sell instantly.
They dumped these phantom coins as fast as they could.
It was run on the bank, but triggered by a bank error in their favor. It's wild.
And in minutes, the price of Bitcoin on Bithum crashed by 20%. It wicked all the way down to $55,000 before they could freeze everything.
That story, I think, is the perfect metaphor for where we are in February 2026.
Oh, so...
Because it just shows how fragile the psychology of this market is. It was a paper error. It wasn't real. But the fear, the rush for the exits, that was very real. And that's what we're seeing on a global scale. The faith is just gone.
It really is. The party that started when President Trump got reelected in 2024, it feels like it's officially over. We're not just looking at a glitch in Korea, we're looking at a global reset.
It is a massive hangover. I mean, since the reelection, Bitcoin had been on this incredible tear, right? It hit that all-time high of over $125,000 back in October.
I remember that.
But according to the reports we're looking at today from Reuters, Investing.com, Galaxy Research, all of those gains have been completely wiped out.
We're hovering below $67,000 as we speak. So today on the deep dive, we're going to figure out why. We're going to unpack this crash, this idea of the Starbucks stuffification of Bitcoin, and a huge new government plan called Project Crypto that might change everything.
And we have to answer that big question. Is this just normal crypto volatility, or is the market's machinery just fundamentally broken?
Let's start with that Starbucks concept. I saw that in the Investing.com analysis, and it really stuck with me. We're not actually talking about coffee, are we?
No. It's an analogy for how industries mature.
Yeah.
Think about your favorite local indie coffee shop. It's cool, it's a bit chaotic, the furniture doesn't match.
The health code compliance is maybe a little loose.
A little loose, exactly. But it has soul. That was Bitcoin, say, 5 years ago.
Right. The Wild West. You felt like a revolutionary just for being there.
Totally. But then the indie shop wants to grow. It wants to scale. So it starts using corporate suppliers, it hires consultants, it launches an app. And one day you walk in and it's clean, it's efficient, and it's boring. It's a Starbucks.
It sold its soul for scale.
Or, to use the financial term, it institutionalized. For a decade, everyone in crypto was begging for Wall Street's attention. We wanted the ETFs, the pension funds.
We thought, if the big money comes in, we take over the world.
Be careful what you wish for. We got them. But the Starbucks effect theory is that we didn't change Wall Street. Wall Street changed us. Bitcoin isn't behaving like a revolutionary asset anymore. It's behaving like a standard risk-on bank asset.
So because the big banks are in, Bitcoin just acts like a bank stock.
Pretty much.
Yeah.
And we can prove it. There are 3 specific kind of under-the-hood numbers that explain this crash better than any headline.
Okay, let's get into the mechanics. What's the first number?
It's Coinbase Premium. Basically, it tracks the price difference for Bitcoin between Coinbase Pro and Binance.
And why does that difference matter? I mean, a Bitcoin is a Bitcoin, right?
In theory. But in practice, where it's trading tells you who is trading. Coinbase is the playground for U.S. institutions, the hedge funds, the ETFs. Binance is global retail. It's the day traders in Asia and Europe.
So if the price is different, it tells you which group is buying and which is selling.
Exactly. And for 21 straight days leading into this crash, the Coinbase Premium was negative. At one point, it was negative $167.
So Bitcoin was significantly cheaper in the U.S.
Which means the selling pressure was coming specifically from U.S. institutions. This wasn't a retail panic. This is a coordinated exit by the big players.
That's concerning. If the smart money is dumping, they're usually reacting to something.
And that leads right into our second number, which is where that money went, or rather where it didn't go, the stablecoin market cap.
Right, so stablecoins are things like USDC or Tether. They're pegged to the US dollar.
Think of them like casino chips. If you're trading crypto and you want to take a break, you cash out into stablecoins. You keep your chips on the table.
Because you're planning to buy back in later, you want the cash ready.
Exactly. Normally, when Bitcoin crashes, stablecoin supply goes up. People sell Bitcoin for Tether. But this time,
It went down.
it dropped by $14 billion between December and February.
So people aren't just stepping away from the table, they're taking their chips to the cashier and walking out the front door.
The money is leaving the building. It's not money on the sidelines, it's gone.
And that explains why there's been no buy the dip bounce. The money isn't there. But why leave now?
That's the third number. And this one really exposes the Starbucks problem. It's the collapse of the basis trade.
I saw this in the Galaxy report. This was the free lunch for hedge funds, right?
It was the golden goose.
Yeah.
So a hedge fund would buy actual spot Bitcoin, and at the same time, they'd short the Bitcoin futures contracts, which were trading at a higher price.
So they're betting it goes up and down at the same time.
It's called being delta neutral. They don't care where the price goes, they just pocket the difference, the spread. For a long time, that spread was huge. You could make 17% a year, basically risk-free.
17% risk-free is insane. No wonder Wall Street showed up.
Right. But everyone showed up, the trade got crowded, and the spread collapsed. Now, that same trade pays less than 5%.
And I can get 5% on a U.S. Treasury bill without worrying about hacks or compliance officers.
Exactly. Why bother? These funds were never believers. They were just doing math. The math stopped working, so they left. And when they unwound billions in positions, they dragged the price down with them.
So the Starbucks deification means we traded the digital gold story for what? Just being another tech stock?
That's the painful part. There's a stat from Bitget in the research that just blew my mind. The correlation between Bitcoin and the IGV ETF.
The software tech stock ETF. So Salesforce, Adobe, companies like that.
Right. The correlation coefficient is now 0.73.
For those of us who skip statistics class, is that high?
It's incredibly high.
Yeah.
0 means no relationship. 1 means they move in perfect lockstep. A 0.73 means that, for all practical purposes, Bitcoin is just a risky software stock now. When the NASDAQ catches a cold, Bitcoin gets the flu.
So much for being an uncorrelated asset. That whole narrative is dead.
For now, it seems to be. We're facing the same problems as big tech. High interest rates, regulatory pressure, all of it.
Speaking of pressure, let's talk about the people who are really hurting. We've talked about the institutions leaving, but what about the retail folks who bought the ETF hype?
Oh, it's a bloodbath. Investors pulled $5.7 billion out of the spot ETFs between November and January. But the ones who stayed. Galaxy Research calculated their average cost basis.
The average price they paid, I saw this, it's around $84,000.
$84,000, yes. So the average person holding those EPS is deep in the red. They are massively underwater.
And that creates a psychological ceiling, right? Every time the price bounces a little, someone who's been holding on for dear life just wants to get back to even.
They sell. Exactly. It creates this huge wall of supply that's hard to break through.
Now, there's a political angle here we can't ignore. This was all happening during the supposed Trump pump. The narrative was that a second Trump term would be a golden age for crypto. What happened?
The narrative hit reality. Expectations were sky high. People were talking about a strategic Bitcoin reserve, about the U.S. government buying Bitcoin to pay down the debt.
And President Trump did sign an executive order about that.
He did. But you have to read the fine print. The order just said the U.S. wouldn't sell the Bitcoin it had already seized from criminals. It didn't authorize any massive buying spree. It was a hold order, not a buy order.
So the market priced in a massive boom, but it got a policy of do nothing, and it collapsed.
And it's personal for the Trump brand, too. World Liberty Financial, the crypto project associated with the family, saw its market cap crash from $6 billion to just over $3 billion. The Trump meme coin fell from $45 to under $4.
And 90% wipeout. Ouch.
It just proves political favor doesn't make you immune to market gravity.
Which brings us to actual physics. We have Wall Street leaving, the Trump trade failing, but there's another layer here that's purely physical, the mining crisis.
This is where finance meets physics. You can argue with a chart, but you can't argue with the weather.
The Miner Mag reported on a massive winter storm in the U.S. How bad was it?
It knocked 40% of the network's hash rate offline. 40%. That is a catastrophic disruption to the network's physical backbone.
But doesn't the network adjust for that? The difficulty goes down.
It does. Difficulty is set for an 11.4% drop, which is the biggest since China banned mining back in 2021. But the problem isn't the difficulty, it's the price.
The price of the Bitcoin they're earning is tanking.
Exactly. There's a metric called hash price. It's the revenue per unit of computing power. It has fallen below $30 per petahash per second.
And $30 is bad.
It's bankruptcy bad. The break-even cost for even the most efficient miners, like CleanSpark, is around $26 to $30. If you're not the best in the world, you are losing money every second your machines are on.
So what do? Just turn them off.
They pivot. And this is a trend you have to watch. Companies like Bitfarms are basically saying, forget Bitcoin. We're moving to AI.
They're repurposing their data centers.
Yes. Why mine digital gold for a loss when you can rent your GPUs to OpenAI or Google for a massive profit?
That's almost an existential crisis for Bitcoin. If the miners decide AI is more profitable, the security of the whole network could drop.
It's a huge identity crisis.
Yeah.
The miners are becoming AI centers. The funds are treating it like a tech stock. The whole soul of the industry feels like it's dissolving.
And here is the big twist in our story today. Just as the market is burning to the ground, the regulators have finally shown up with a fire extinguisher.
Yeah, better late than never, I guess.
Let's talk about Project Crypto. This comes from a Jenner and Block briefing. What happened on January 29th?
Well, the SEC and the CFTC, the two biggest financial watchdogs in the U.S., they finally buried the hatchet. They launched a joint initiative called Project Crypto.
For anyone who doesn't follow DC turf wars, why is this such a big deal?
Because for a decade, these two agencies have been at war. The SEC says crypto is a security, like a stock, so we control it. And the CFTC says, no, it's a commodity, like wheat, so we control it.
And all the crypto companies were stuck in the middle getting sued by both of them.
Constantly. So Project Crypto is a peace treaty. You have SEC Chair Paul Atkins and CFTC Chair Michael Selig finally agreeing on what they call a shared taxonomy.
Shared taxonomy sounds incredibly boring, but I'm guessing it's really important.
It is everything. It means they are finally writing down the definitions. Are you a security or a commodity? They're setting clear rules for tokenized collateral, for loans, and this is key, creating safe harbors for software developers.
So if I write code, I don't go to jail just because someone else uses it for something illegal.
Correct. It's a very pro-business, pro-innovation framework. It's the regulatory clarity everyone has been begging for years.
The irony is just incredible, though. We finally get the adults in the room regulatory framework at the exact moment the price is completely collapsing.
It's that paradox of institutionalization again. Regulation brings safety, but it often arrives just in time to pop the bubble. The Wild West era is over. We're in the era of compliance now.
So with the Wild West gone, the miners looking at AI, and the institutions selling, where do we go from here? The Investing.com analysis laid out 3 possible scenarios.
Right. Scenario 1 is the bull case. And this depends completely on the Federal Reserve.
The Fed save us strategy.
Pretty much.
Yeah.
If the Fed cuts interest rates, liquidity floods back into the market. That basis trade becomes profitable again, the hedge funds come back, and prices grind their way back up to maybe 85 or 90,000.
Okay. And scenario 2.
The boring case. Stagnation. The selling stops, but no new money comes in. Bitcoin just chops around between 60,000 and 75,000 for months. A zombie asset.
And the third one, the one keeping people up at night.
That's the bear case. This is where we break below 60,000 and stay there. If that happens, the miners we talked about, they go bankrupt. They're forced to sell their Bitcoin reserves to pay their debts. Then corporate holders like Strategy face margin calls.
A forced liquidation spiral.
It could push the price all the way down to test $40,000.
Is there any data right now pointing to which way we're leaning?
It's a mixed bag. The Galaxy Research report points out that 46% of the total Bitcoin supply is currently held at a loss. That is a lot of pain out there.
That sounds like the bear case.
It does. But on the other hand, they also noted that whale selling has slowed way down. The really big holders have stopped dumping as aggressively as they were.
So the big players might be waiting to see if that $60,000 floor actually holds.
Exactly. We're at a stalemate.
This has been, well, pretty sobering. We started with a glitch that made people millionaires for a minute, and we've ended with a market that seems to be fighting for its own identity.
I think the takeaway for you listening is that the teenager phase of crypto is officially dead. We all wanted Bitcoin to grow up, to be taken seriously. And it happened. We have ETFs, we have correlation with the NASDAQ, we have regulatory committees.
And we have institutional panic selling.
That's the price of admission. When you invite the institutions in, you get their capital, but you also get their fear, you get their algorithms and their quarterly pressures.
It really brings us full circle to that Starbucks analogy. If Bitcoin is now just another tech stock governed by the SEC and CFTC, does it still have a soul? Or was that $125,000 price tag just the cost of selling out?
That is the multi-billion-dollar question, isn't it? If it behaves like a software stock, maybe it should just be valued like one. And right now, software stocks are having a really tough time.
A lot to think about. I'd encourage you, as you listen to this, take a look at your portfolio and ask yourself, are you holding digital gold or are you just holding some very, very volatile software? That's it for this deep dive.
Stay curious.